Assalamualaikum warahmatullahi wabarakatuh. We are going to present about bankers acceptance. Before that, I would like to introduce our group members. So the first one is Nur Fatihah, the second one is Farisha Irayu, and the third one is me, myself, Balkis Umaira, and the fourth one is Nur Natasha Adira, the fifth one is Nur Lia Shakila, and the last one is Nur Izzati Shakila.
So, what is bankers acceptance? Bankers acceptance is a bank's promise to fulfill a request future time. Normally, the request will include the payee, the amount, and the due date for payments. The request becomes the bank's unconditional liabilities on acceptance. Bankers' acceptance can be exchanged on the secondary market since their ownership can be transferred before they mature, which sets them apart from regular time draft. Bankers' acceptance are widely used in international trade to lower credit risk in transactions involving strangers. They allow buyers to replace the seller's creditworthiness in future sales agreement, typically lasting 1 to 6 years. The market players for bankers' acceptance is banks, corporations, investors, financial institutions, and regulators. First is bank. Banks play a big role in the market for bankers' acceptance. They issue and accept this instrument which can provide short-term financing for clients. Bank acceptance are seen as relatively low-risk investment. They are common in many countries including Malaysia. Second is corporations. Companies often use bankers' acceptance to fund their operation to manage cash flow. They ask banks to accept draft which can be sold to investors. Bank acceptance are seen as their low-risk investments and they are commonly issued by well-known organizations. Next is investors. Investors like money market funds, insurance firms, and pension funds buy bankers' acceptance. They are low-risk investments sold on the money market. Investors in bank acceptance usually receive a smaller return they would on higher-risk assets, such as equities, in exchange for this lower risk. Bank acceptance are considered liquid, making them easy to buy and sell. Then we move to financial institutions. Banks and financial institutions like investment and merchant banks are involved in bankers' acceptance market. They issue or accept bankers' acceptance based on their business activities and customers' needs. The institution recovers funds by debiting the importer account and paying the exporter on a specified date. Last is regulators. Regulators like the central bank or securities regulator oversee the bankers' acceptance market and enforce law. They protect investors and ensure fair market functioning. Different countries have different regulator bodies, like the Federal Reserve in the US. Regulators set rules for issuing and trading banks' acceptance. They monitor banks to ensure compliance, restrict insurance, and protect investors from fraud.
Hi, okay, so now I would like to explain about background of bankers acceptance. So bankers acceptance is a short-term issuance by a bank that guarantees payment at a later time. A bankers acceptance is often used in importing and exporting, with the importer's bank guaranteeing payment to the exporter. A bankers acceptance differs from post-trade check-in that it is seen as an investment and can be traded on a secondary market. Applying for a banker's acceptance is similar to applying for a short-term fixed rate loan, and the borrower goes through a credit check and sometimes extra underwriting processes. And the last one is banker's acceptance is similar to buying a treasury bill. An investor on a secondary market might buy the acceptance at a discounted price, but still get the full value at the time of maturity.
The next part is the benefit of banker acceptance. The first one, we have facilitation of international trade. The international trade industry is essential to the global economy, and bank acceptance plays a crucial role in this complex ecosystem. When companies conduct cross-border transactions, trust and creditworthiness issues become more significant. Bank acceptance acts as a dependable middleman by providing an unwavering guarantee that payments will be made, reducing the risk of non-payment and boosting trading partner confidence.
We have enhanced liquidity. Businesses often have unstable liquidity, particularly during uncertain economic times. Bank acceptance offers a flexible solution by acting as a financial guarantee and being tradable on the secondary market. This instrument negotiability makes it possible for businesses to obtain cash fast, which can be a lifesaver for those with unforeseen expenses or short-term financial needs. The increased liquidity that comes with bank acceptance also helps businesses become more resilient financially overall. The third benefit is credit enhancement. The foundation of a business financial health is credit worthiness. In this situation, bank acceptance becomes an important instrument since it communicates a degree of confidence in an entity's capacity to meet its financial commitments. Consequently, companies who use bank acceptance can see an increase in their credit score. In addition, to make finance more accessible, this improved creditworthiness help companies to bargain for better terms from suppliers and other stakeholders. And for the last benefit, we have lower financing costs. Business operations depend heavily on finance, and the cost of financing has a big effect on the company's bottom line. When compared to other approaches, bank acceptance frequently results in reduced financing costs because to its intrinsic guarantee and lower risk profile. Businesses involved in international commerce or those who strategically integrate bank acceptance into their financial operation benefit from the more favorable interest rates made possible by the confidence that the bank's acceptance.
The first one, short-term maturity. Bank acceptance issued by commercial banks have a short-term maturity of less than a year, making them attractive for investors and businesses as low-risk investment option. These acceptance typically range from 1 month to 6 months, with the money required to be returned to the depositor. Second characteristic, high liquidity. Banker receivers are popular for their ease of conversion into physical currency, increased liquidity, and low risk. They are highly liquid assets often traded in the money market, making them attractive to investors seeking quick capital acquisition. Additionally, they offer convenience in purchasing and selling instruments at minimal cost and minimal price. Third characteristic, issued by bank. Bankers acceptance where the importing bank guarantees payment to the exporters are used in import and export transactions. The issuing bank guarantees a time draft, a payment that is not fully paid until after a certain period. Time draft are short-term credit used to finance good transaction in international trade.
Then, the third characteristic of bank acceptance is credit quality. It is a primary financial criterion that is employed while assessing the investment quality of bonds and other type of bonds. When purchasing a bonds, investor can get a sense of default risk and worthiness of the bonds by considering credit quality. The profit or the risk that the bank will incur if it accepts the offer and proceed as the third party in the agreement or contract are what we mean when we describe a banker acceptance. Besides that, the parties' creditworthiness is taken into the consideration when granting a banker acceptance. For arranging this deal, the banker receives a commission. Therefore, the contract's successful execution affect the bank profit. The last one is marketability. The fact that it's possible to sell this financial instrument. It can be sold to third party in the same way as any other financial market instrument because it is negotiable document with a brief validity period. A bank that is well known for its excellent ethical standard and stellar reputation is likely to have numerous lenders willing to approve the offer. Other than that, this is also a marketable short-term debt product may be sold. In this scenario, the responsibility of repaying the loan has been transferred to an entire other entity. Only because of the entity moral standard and strict credit evaluation criteria is such a transfer possible.
Bank
Banker acceptance are popular short-term debt instruments in international trade finance. They are issued on the buyer's behalf by the buyer's bank, and they provide the seller with an conditional payment order. The seller has the option of keeping the banker's acceptance until maturity or selling it in the secondary market for liquidity before the maturity date. The maturity time for a banker's acceptance is normally decided upon during the underlying trade transaction negotiation and is mentioned in the acceptance agreement. The maturity term is the amount of time it takes the buyer to pay the bank for the approved draft. A banker acceptance mandates the bank to pay the holder a predetermined sum of money on a predetermined date and typically issued 90 days before maturity. But they can mature at any time between 1 to 180 days. It normally has a maturity period of 30 to 180 days, though this might vary depending on the term agreed upon. The maturity period is the span of time that passes between the issuing of the banker's acceptance and its maturity or payment date.
To conclude, bankers' acceptance are short-term financial instruments that banks issue for their customers. They are widely accepted, easy to trade, and seen as low-risk investment. Bankers' acceptance supports trade, ensure payment security, and offer competitive interest rates. They have international recognition, are regulated by authorities, and help with liquidity in commercial transactions.
Thank you.